Start recording. I'm going to screen share.
Why's my hair gone crinkly?
Just call that on the recording, John. So good morning, everybody, and welcome to the Guildford Hub, where we're talking about managing cash flow and having it all explained to us today by Will, with support from Laura. This is the Guildford Hub, where we're all about education, inspiration, and collaboration. And we normally meet at the wonderful Harbour Hotel in the social bar. But unfortunately, with that being closed, we are doing everything on Zoom. I've no idea when we're going to be able to get back to face-to-face meetings. Obviously, lockdown has allowed us to get into pubs this weekend and restaurants, but I think we're still a way away from holding networking type meetings or education sessions like this. But there will be a Zoom version going forward anyway, so that's great. So briefly today, who's been getting things done? Anyone want to chip in with anything they've been getting done?
Yeah. Well, actually, last night hang on.
Damon Burke, so good they gave them to us twice.
Yeah, last night I managed to complete a large section of my e-commerce CRM system, and the database has doubled in size overnight.
Oh, good.
That's not content, that's number of tables, etc. So I'm moving
Excellent.
on to the next stage. So I'm really happy with that. So
good stuff. Good stuff. So are you in beta testing with your client on this?
Yeah, one section's in beta testing because it's very modular. One client stroke colleague is using a small part of it in sort of beta testing. I'm now developing other sections. So far the testing's gone quite well. So
well, when it gets closer to completion, Damon, we should have a session from you about how to construct and all the wherewithal that you need to think about to when putting together or thinking about a CRM system. You might even manage to get the odd customer.
Sell a few. Yeah, probably closer to the end of the year, but I'll be really up for that.
Yeah, no, that'd be really good, really good. How about you, John and Fiona? How you been getting on?
All right, we've got our bounce back loan through finally.
Oh, excellent, excellent.
So that's just got to work out the best way to use it to grow our business. And
we managed to get all our hand sanitizer finished, and we've just got to take it over to Signal, so that Dave from Ace Cleaning can pick it up.
Excellent, excellent. Really good stuff. Well done, well done. We had the 15 in 2 LinkedIn challenge as part of launching the Linked Business Mastermind last week. So that was what I was focused on last week, or rather, I was focused on trying to complete that whilst dealing with a virus which I thought might be COVID, which turned out not to be COVID, which is a relief. So last week was a bit topsy-turvy for me. I was pretty unwell for most of it. But came through the other side. I have to say the testing regime was brilliant. I logged on at about 12:30 to try and find a test. Found that there were over 6,700 tests available in the Surrey area over the next 4 days. So booked a test for that afternoon at 2:30 for 3. Turned up, was done by 3 o'clock. And woke at 7:30 the following morning to find the test results in my inbox and on my as a text message as well, to say that I was clear. So I was very, very impressed, actually. So if you do have any symptoms, I would suggest you get yourself a test. I wasn't claiming to be a key worker, although I do have certain privileges as a Samaritan, but I didn't even have to use those. Just logged on because I had symptoms, and that was it. And it was very easy to get the test, get results quickly. So strongly encourage that. I'm now working on a revamped version of my a guide to creating a great LinkedIn profile, because I recognized that somebody actually tried to download it the other day and it didn't work, and that's because I'd taken down the marketing system behind it. And I thought, yeah, I've really got to sort that out. So I'm doing this as an exercise for later on in the hub, as building a practical funnel using my new LinkedIn guide and simple steps to create a manual funnel. So none of the funnel automation like click funnels and stuff like that. I'm going to use as basic as possible I can to demonstrate how easy it is to actually put together a lead magnet and get it out there. So I'm not sure if I'll be ready for next Monday, in which case we'll do Mastermind instead. But if later in the week I am ready for it, then we'll do building a practical funnel next week, Mastermind the week after. And then I'm going to talk about LinkedIn ads towards the end of the month. Because I've been looking at LinkedIn ads. They're getting much more like Facebook. Got a lot more targeting options there and some, lots of campaign options there. So I'm going to take you through how LinkedIn's advertising option is coming along. So that's what's coming up at the hub. Just a reminder that there was the Linked Business Mastermind launch last week. So there's a replay available. So if anyone wants that, give me a shout and I'll put the link in the chat box. But we're today talking about, and of course, don't forget, as members, you get one-to-ones with me. So book your one-to-ones if you need one. And finally, we're going today to be talking about managing cash flow with Will and Laura. I'll leave Will to explain everything because this is the start of, we're hosting the first of a series of 3. So I'll leave Will to explain all of that. So I'm going to stop sharing my screen, hand over to Will, ably supported by Laura, and we can get into the meat of today's session. So bear with me just a second. Right, Will, over to you to start sharing.
Hey. Is that working?
Yep.
Yep. Right. Hello, everyone. Nice to speak to you all. So I'm just trying to see if I can swap the screen. It's on. It's not angle. So yes, as Alan said, this is the first of 3 presentations that we have put together on cash flow. The first one is in conjunction with the hub and presented in the usual hub slot, and then we have 2 more, so one tomorrow and one on Wednesday, both at 10 a.m. We've got some links for the sign up that I'll send out later. Laura, would you like to?
I would.
Carry on?
So you haven't met me before, but I'm director of Rebel Accountants, and Will is our wonderful consultant. My husband is Rob Van Eycken. He's the principal accountant at Rebel, and we've been going about 4 years. And we put this cash flow seminar together because we just think it's absolutely fundamental. Good times, bad times, whether you're focusing on growth, which it seems some of your members are. It's just something that's rarely spoken about by accounting professionals in kind of an open dialogue here. So we thought we'd seize the moment and put this together and share our thoughts, really. And I think Will has spoken about who Rebel are, but we're a full service firm. If we can't do your tax planning because it's super complicated, we work with other professionals, a trusted network of professionals who we call the Rebel Alliance. And we can refer your work out, but ultimately we can do your accounts, tax, payroll, and bookkeeping, all within our team. We're a team of 7 now, so we've grown quite quickly over the last nearly 4 years. We're Xero certified practice. We love Xero. We think it kind of integrates so well with kind of your startups to medium-sized businesses. And it's just by far and away the best system that we've come across. And it's something that we really sell to our clients, and it works well with us in providing our services. And ultimately, we're focused on detail and getting things right, and that's who we are. And yeah, our clients are really telling us that they're enjoying our services, and I think recently there's been so much to get to grips with for businesses like yourselves, that we've found that being proactive, sending our updates and reaching out to our clients on a bespoke level as to how they can survive these times has really stood us in good stead for our own business over the next coming months. And we just want to make sure that we're capturing lots of businesses in that kind of momentum. So with that in mind, I'll hand back to Will, and he can talk you through what we're talking about today, really.
Thank you.
Thanks, Will.
Okay, so what we are going to talk about today is the exciting world of cash flow. However, before we get to cash flow, I'd like to have a little chat about working capital. Firstly, what it is, why it is important, and how you go about calculating working capital. Briefly, it's the funds of the business and the actual cash you have to use day to day. But I've got a few examples and just to show what things you can do to change that and how working capital is important along with cash flow. Then on to why you should prepare a cash flow. I think the first point of that's quite obvious why you should, but a little bit more detail into that. How to go about preparing cash flow, and then a few tips on from us about how to get some cash flowing in. As we've mentioned, we do have 2 more webinars coming up the next couple of days where there's a much more detail onto how to actually construct cash flow. So some tips on to use Xero to do it or to use Excel, and a bit more of a detailed look into managing debtors and money in and money out, and things like if your clients go insolvent, what your rights are, lots and lots around that. So 2 more webinars, more detail. This is a bit more about working capital, this first webinar. So cash flow, it's key. Without cash in the business, you can't run. You can have profit, you can have sales, but without the actual cash, you're not going to go too far. So we just want to talk in detail about the cash flow. Sorry, I'm just going through my notes here. We need, as I'm struggling here, communication is the key. Cash flow is not just profit and loss in finance department focused area, it's key across the whole business. So businesses where you've got different functions, you need a cash culture and a communication across the whole business about why you need the cash flow is so important, especially at these times. You need lots of detail in your cash flow. It's all well and good saying you've got a cash flow report, but is it actually doing the job it should be? And can you rely upon it? So not just for future planning, but should you be looking for future financing or funding? People are going to want to see your future projections and cash flow. And that's where you need to know your cash flow so it can be scrutinized and you can explain it and to talk about it. We can help with your cash flow. We can help with the initial scrutiny. We can help with the initial preparation of it. And that gives it a bit more reliance on if other people are looking at it. If you could say your accountant's helped out with it or has provided input, that's where we can help as well. So after all that, finally at the end, you can ask, there'll be some question or time for questions. Please also do ask questions as we go along. So interrupt. Alan, will you monitor the chat box if that's okay? If anyone has questions.
I'm monitoring the chat box and I've actually popped the links to the next 2 webinars.
I did see. Thank you very much. I had them saved for later. Thank you.
Yeah, no, I've popped them in there already. So if anyone wants to book onto those, there's the Eventbrite links are in the chat box now.
Thank you. So that's who we are. There's a picture of there of me with a bit more hair before my wife got hold of the clippers and decided that a shorter look was better for me. That was a scary experience that I don't want to repeat. So working capital. So this is the capital or the cash of the business, which is used day-to-day operations. So this isn't money that's sort of locked away elsewhere. This is sort of the money that you can use to pay your immediate bills, the money that's coming into your bank account. So at your year-end date or any point during the year, if you look at your balance sheet, it's sort of your cash balance. So we don't think about the money that's coming in or the money that you've got to pay. It's sort of the money in your bank, and then what can we do with that? And from that, you think, do you have enough cash to pay your short-term debts and expenses? So not everything comes in as on an invoice, but you might know that once or the first of the month, your direct debits go out. So plan for that. And then once all those debts are paid, what money do you have left to play with? But you also then need to consider money that could be coming in from your customers if they are good at paying you on time. So as a general rule, it is current assets less current liabilities. So short-term amounts owed to you plus your bank account plus stock less everything you've got to pay. Now, within current liabilities, it's anything up to 1 year. So that does include items such as your corporation tax bill, which is due 9 months after your year end, your VAT bill that's due within the next quarter. So as good as this is, you do also then have to think about short and longer term current liabilities, if that makes sense. So we've got items that are immediately due and things that are due a bit later. Within current assets as well, there's a few other funny items. So the obvious one is your sales invoice that you've sent out. Fine, that money's due to you hopefully in good time. Your accountants might make some adjustments for things such as prepayments. So a good one example is an insurance bill. If you pay all at once, your accountant will then spread it over the rest of the year. So we need to think about that as well, because that's a cash item that you've paid, but there's actually no future cash to pay out. It's an unwinding process in the accounts. Another current asset is stock. So hopefully your stock is good stock that you can sell and it sells quickly, but current times it might not be turning over as quick as you like. There might be some old and obsolete items in there. So we'll come on to an adjustment you can make for stock a bit later, but it's another thing to think about. And I'm not trying to say this working capital calculation is flawed, but there are things to consider when you're thinking about it. So as I said, you might have seen this on your balance sheet before as net current assets. So this is the figure that as accountants we first look at a balance sheet. If all your money was to come in and you'd pay all your liabilities, have you got enough money for the business to be solvent effectively? Now I've come up with a couple of examples from sets of accounts. Two businesses that I've got minor interest in, one being beer and one being my rugby club that I support. And you can see they're in slightly different situations. So Bath Ales Limited Brewery, I really like their beer. As you can see, they've got stock of almost £500,000, which would be expected. We've got lots of beer and lots of bottles of beer ready to sell. I'm slightly surprised their debtors are so high at almost 2 million, but there we go. Perhaps they've got lots and lots of pubs in the local area that owe them lots of money. And they've got about £1 million in the bank, which is pretty good. The balance sheet date is the end of August, so it is the end of summer, so you would expect them to probably have a bit more cash in the bank. Had a good summer. But the net result of that is they've got almost £2 million in net current assets, which for a business this sort of size, I think is pretty good going. They're doing pretty well there. On the other hand, we've got my beloved Gloucester Rugby, who, as a sports club, possibly expected that they are running at a loss and pretty much are insolvent. If it wasn't for £7 million worth of share capital, they wouldn't be in a huge, great position. But there we go. So they have almost £2.5 million due in debtors. So that'll be, I would assume, that's season ticket sales due to them for the rest or for the future season. £5.5 million in the bank, which must be all the prize money they won that season. But they do have almost £9 million that they're due to pay out in creditors, which is quite a scary thought. I would have thought to owe £9 million with only £8 million coming in. So that's why they've got a net liabilities of £1 million. So if we were to do the working capital as a pure number basis, you would say Bath Hill's brilliant, 2 million. Gloucester Rugby not so great, £1 million in the red. So the current ratio puts a numerical figure on these numerical figures. It sort of gives an absolute result or a ratio that you can use and then compare, because those balances are going to change all over time. So your assets might go up, but your liabilities might go up, or vice versa, and the numbers will change. But what you want to do is have a ratio that you can compare, firstly against other periods, and then secondly against other businesses, see where you're sitting and where your trend is going. So it's a fairly simple calculation of current assets divided by current liabilities, and you like to see a result of 1.5 to 2. Anything below 1 essentially means you have net current liabilities, you're in a loss-making position. Some businesses that's okay with, but we like to see 1.5 to 2. So in our examples, Bath Hill's had a ratio of 2.2, Gloucester had 0.89. So where we've got there, say Gloucester below 1, not great. Bath Hill's actually 2.2 are coming out very good, which then does indicate perhaps they've got a little bit too much cash or too much working capital. Could they look to do something else with this surplus cash? It might be that they know that coming up they've got a lot more payments to make or future debts coming in quicker, so they're building up for that. But it's a consideration. There we go, that's my point. It does differ between industries. So as I said, 1.5 to 2 is generally considered good, but if you think of things like a supermarket or pubs and restaurants where you pay at point of service, your debtors are going to be very low. You're not going to have money owed to you, so you can get away with the number being a little bit lower. For you as a business, it's probably better to look at the trend. So do this monthly, quarterly, and have a look where your trend is going. Are you on an incline, a decline? Are you maintaining where you are? That's the key part of this. And I said also you can compare business to business, but you need to be a little bit careful when you're comparing apples with apples. You start comparing yourself with, I don't know, if, for example, Revel started comparing themselves to PwC. They're both technically accountancy firms, but they're going to be in slightly different positions. Next, we move on to the acid test or quick ratio. And this is where I was saying before, you adjust for items that are slightly more liquid items. That's what I'm trying to get at. So you tend to keep in most of your short-term liabilities, but you remove assets that aren't really cash at the time. So if you were suddenly needed to pay a big bill, what cash could you get your hands on quickly to pay that bill? So we generally get rid of stock from this calculation and any cash that's locked away. And you can also adjust for, as I said, things like prepayments. So the general rule is cash and cash equivalents. So money you've got your hands on at the bank. Trade debtors, even I think that figure could be played around. I think you should probably do a bad debt adjustment for this figure. So trade debtors that you expect to be paid, and liquid investments is the term. So if on your balance sheet you had some shares that you could sell quickly, or I don't know,
Will, you said
a fleet of cars that you could sell, something like that.
Yeah, Will, can you hear me? Yeah.
Yeah.
You said you'd make an adjustment to the trade debtors for bad debts. What about debts, trade debtors that you know are on longer terms? So, for example, if you were selling to Tesco's, then notorious about how long they make you wait for payment. So, you know, would you think about adjusting and taking out any debts?
So longer term trade debtors.
Yeah, any recent invoices to Tesco's are not going to get paid for, say, 60 to 90 days, or maybe even 120 days. So you might want to look at taking only your trade debtors that are due within the next 30 days to get a realistic short-term cash position.
Certainly. Sort of, I'm going to go on to in a minute what the use of this acid test. The more you can adapt it for you, the better. But if you're adapting it for yourself, sort of make sure you're doing that every time you run this calculation and looking at the trend.
Yeah.
But certainly.
And am I right in thinking Xero would enable you to do that, to take in only debtors due within 30 days? Or
so, thank you, Alan. In one of our future presentations, there's a new tool in Xero called the cash management tool, and this is where you can type in, or you can set when you think invoice is going to be paid and when you think you're going to pay suppliers, and it will project your cash balance for the next 7 days or 30 days. So yeah, definitely it's something you can do in Xero.
Excellent.
But you could also do it from a trade debtors report. You could say debtors that are within 1 to 30 days or within 1 month you could include. Yeah, thank you for that hint. So again, results differ industry to industry, and this is probably a better indicator for businesses that hold stock. Anything below 1 is not bad, not good news. And again, look at the trend. If you're on a downward trend, you're looking like you might be going face first into a slight liquidity issue. Again, this is an indicator. It's a bit of a future warning system to see where you are. Now, there's quite a lot of numbers there. And when Laura first looked over this presentation, I think she was a bit like, oh my word, you're going to talk through lots and lots of numbers and theory, which I was trying to lay the groundwork, because this is where it gets a little bit more interesting, onto the working capital cycle. This is how long to turn your net working capital into actual cash. This is what we're really interested in. When can you get the money into your bank account, and what's your cycle, your working capital cycle. So it's a basis based on number of days, not a numerical figure. So the lower the number, or the quicker, is better. So the quicker you can turn around this, the quicker that you can then put this cash back into use to earn you some profit. So we take your inventory days, so the amount of days that you hold stock for before it gets sold. So hopefully this is a relatively small number. You haven't got stock that you've held for 740 days or something. So how long before your item of stock is converted? And then we add on, how long does it take you to get paid on average? And then you take off, how long can you delay making payments for? So from when you purchase the good, so you've got the item in your stock, plus how long it takes to get paid for that, less the days that until you pay. So that gives you a numerical figure of how long your money that you've paid for that stock is not earning money for you. So we've got a little example here, fairly simple one. If you hold stock for 5 days, so this is a pretty good business if they're only holding stock for 5 days, or quick turnover stock, perhaps a short life good. On average, it takes 30 days to get paid, but you don't pay for the initial item that you're converting into inventory for 15 days. That means 20 days before what you purchased gets sold, and you're getting the money in for that, or the margin is what we're looking at. Once you're paid for your invoice from your customer, that's effectively when your profit margin is being realized. If you could tweak this around, so for example, we're going to say you still sell it within 5 days, but you can push or work with your customers so that they actually pay you within 25 days, so you're not 5 days off there. And you can delay making your payments for another 5 days. Obviously, you've got 10 days better off. So you're only out of pocket. I say out of pocket. You're not. You're getting the gross margin within 10 days now, and you can then see if you can rotate that over a whole year. I'm not saying you all work 365 days a year, but 36 odd times a year you can be selling that one good on. And this is a useful tool to have a look at and track. You can once a month, once a quarter, just to see where you are. See, is something slipping in the process? You might do a big focus on your debtor days, get your debtor days down, but then lots of people are demanding money from you as well because of the current situation. So you're actually making payments out quicker. So all the work you're doing on bringing your money in is just going out the other way. You're not, both ends aren't tying up.
Quick question for you, Will.
Yes.
If you were, say, a property business,
Oh, yeah, your inventory is very high.
well, your inventory is very high in terms of you've got the capital investment in the properties that you're letting, but would you count that as part of your working capital per se in this broader in a broader sense? You would, because you've got to put the money into the business in the first place, but that working capital is never going to come down. It's going to be fairly static for the actual purchase of the property. But if you were looking at this on a sort of how to manage your cash flow basis, I'm guessing your inventory days, would that be, so, say you were looking at, you had 4 HMOs with 5 rooms in each HMO, so you've got 20 rooms. Would you look at your inventory days as being the average number of days that you have a vacancy in a room as being your inventory days?
So is this more if you're trying to rent it out?
Yeah. So you've got 4 houses of multiple occupation. Each house is split into 5 rooms. So each room is like an inventory item, which you're selling. On an ideal basis, you've got your rooms fully let, and you've got no inventory left to sell. You're still getting money coming in, and you're still having to pay out utility, council tax, that sort of stuff. But then if you get voids, then you've effectively, that's like all of a sudden you've got a product on the shelf and you've got to sell it. So would you take the average number of days, void days you've got in your rooms as your inventory days?
Yes, yeah, definitely. I say with most examples you'll find it's all based on a factory. That's how every example you find on a factory making widgets. So you do have to play around with this slightly for what your business is. So inventory is changed to what is the product you're selling.
Yeah.
So for us accountants, it could be how long from you get the data in from the client for us to send out the accounts. That's effectively our inventory days, work in progress days.
Yeah. So again, thinking for another business that I know is going to listen to this webinar later, they hold a huge stock of items that they then they rent out to people for events. So everything from knives and forks, cutlery, crockery, through to chairs, tables, linen, all sorts of stuff. How would they consider that to be? What would they consider to be inventory days there, or would this model not really quite work in that way? We'd have to.
I'm not sure it would work too much because they're
going to get paid in advance, aren't they, of the event?
Yeah. Also, they're not really. I guess once they've purchased the stock, they've got it as stock, as in a good stock, right?
They're not stock that they sell. It's stock that they hire.
So it might not be a brilliant model for them, but they should definitely be looking at their debtor days. If they can categorize their different products into ranges and then track that, so then you can see all. For example, do people not pay for cutlery as quicker as they do for, I don't know, a marquee? Or it might be the other way around. Track it that sort of way.
So I think the essence of the message is that these are the core principles, but for each business, you need to sit down with your accountant, a switched on accountant, to help you create the right measures for you to help you manage your business so that your business stays as profitable as possible and you're maximizing the use of your capital employed.
Yes, definitely. Yes.
Yeah.
So for service businesses, it's not the best tool, but it's there to get you thinking, as you say, start coming up with ideas.
Excellent. Thanks for that.
Sorry, John and Fiona, do we treat our project lead times as inventory days? Yes, effectively you would. So it's sort of days where, do you purchase much in terms of the lead time, or is it time you've invested yourselves? You're on mute, I'm afraid. Okay.
Yeah, well, it didn't work unmuting then. Yeah, it's that's the I know it's a bit more complicated than that, because we're paying subcontractors in stage payments, and we may be paid in stage payments. But in round terms, presumably the time taken from getting the order and delivering it is effectively like an inventory time, because the longer that is, the longer we're out of pocket.
Yes, I'd probably go from the first day you make a payment, or you receive an invoice from a supplier for you to make a payment, to the day the project's signed off, and you send out an invoice would probably be your inventory or work in progress period. But for you, it's probably going to range over project by project. I think some you'll hopefully turn over quite quickly, and then other bigger projects will take a little bit longer.
You might break it down into several sort of sub projects if you are getting stage payments. So you'd have whatever length duration it is from the first payment out until the first stage payment is made as your first phase, and everything you pay out towards that first phase is included in that first phase capital requirement, and then whenever you start paying out for anything for the second phase, even if that's before the first phase ends, that's the start of your cycle for the second phase, etc.
And John and Fiona, do you have software where you can track projects or phases within projects?
Our software does have a project code number, so we can put, and we haven't fully implemented it yet, a system where you can put a project number against each payment and receipt.
Yeah, then you can track, are you making margins on those projects? And do that sort of thing.
Very muffled there, Will.
Oh, sorry. That's my hand in my. So yeah, you can put project codes or even sub-project codes against certain parts of the project, and then track money in, money out, payment days. I think Xero should be able to handle that. I think QuickBooks would as well.
Yes, we're on something called Cashflow with a K.
But which is and Cashflow is really
clunky.
It's getting clunkier and clunkier. So we want to migrate to Xero.
Okay. Well, I'm happy to have a chat. Yes, we got a couple of clients on Cashflow. It doesn't seem to have progressed as much as other software has. I think at one time it was.
Definitely not.
I think that's a problem. It's beginning to fall behind the others.
Yeah.
Okay, as we're talking about Cashflow, let's move on to why you should prepare a Cashflow. That was a nice little lead in, thank you. So, as I said, the first and most obvious point is it allows you to track your cash balances, which is great. You can project forward and start to use it to make decisions. But to track the points we have: cash surpluses, cash deficits. Are there points where you can do something with the surplus cash, or can you target a point where you think you might be in your overdraft or over your overdraft limit, and you can give the bank or whoever a heads up to say, we're going to have a couple of issues now, slightly behind. Also with a cash flow, you can use it to track what you think is going to happen, but then you can start playing around with it and say, well, what if this happens? What can we do if, for example, we were to delay our payments out to suppliers for an extra 10 days? How would that impact on everything? Or if we were, this one big person that owes us money actually didn't pay us for an extra 30 days. What if I plug that number in and move it somewhere else? What is the impact then? And then can we start to think about what sort of measures and procedures do we need to put in place for that? There we go. Improves knowledge and error future planning. So you can also use it to sort of, what am I trying to say here? If you can track what your projections were from the past and how accurate you were, you can use that knowledge to make your future projections better. You can say, actually, I was spot on with that point there, but actually we weren't great on that point. So in future, we need to build this into our model to say, yeah, this customer actually, we think they're a good payer, but actually we do have to chase them twice and they're actually paying after 35 days instead of 25. So let's build that in. And it also then allow you to say, we need to target this customer a little bit earlier in the process, because they do pay us once we chase them 3 times. So if we get our 3 chases in a bit earlier, hopefully they'll pay us a little bit earlier. Okay, sorry, I've got a few more points here that aren't on the slide. You can also use it to change your mindset slightly. So you might be thinking, this is worst case scenario, what happens if this doesn't happen, this doesn't happen? And you're focusing on survival rather than looking at how can we grow the business. So if we were to say, oh, sales will go up 5% every month, then what happens? And you can start planning, and it give you a bit of a boot up the bum to say, right, let's get going. Let's turn this around from always being like, oh, when's the money coming in, to let's grow, let's push this forward. Another good reason I think I mentioned earlier was finance and support. The lenders, they all want to see a cash flow, and they will want to be able to see that you can talk through your cash flow and explain points to them. I know with the bounce back loans, there hasn't been much required to apply for them, but going forward, I definitely think it's going to get stricter and stricter. I would also expect government support to tail off and more reliance on outside lenders who are going to want more and more detailed, especially if they know lots of businesses got bounce back loans. They're going to want to see that forecast into your financial position. What else? You can also, once you've got your cash flow set up for monthly or the next 12 months, you can start digging down. If you've got trend season or seasons, or you can start playing around with those items. I'm not sure grease and oil plants if you have peak seasons or not, but so accountancy, we tend to know that we have a little bit of a busy period start of May time. Also January's a busy period because people go crazy and leave everything to the last minute. But we know that August tends to be a quieter time, so we can build that into our models and say, what liabilities have we got to pay here, and are we going to have just a short-term potential issue for that 1 month or that 1 period. So what can impact on your cash flow? Well, I think the first one was, what happens if a global pandemic hit and everyone stopped buying everything and there's just massive changes in consumer demand? How is that going to impact? And I think hopefully a lot of people now coming through this are starting to see, actually, we need to have something in place for future, because it seems like a one-off, but if it happens again, it's not a one-off, is it? And we need to then start thinking, is there a template or a implementation process you can put in place should this happen again? Can you get onto your phone to your customers quickly to start saying, look, we're implementing COVID-23 plan or whatever it is, to say this is what we'd like to happen. What else can impact? If you have one major customer, if you lose them, what is going to happen? So a few service businesses would probably potentially with IR35 have one major customer. So what would happen if you can no longer work for them? Because, as I said, IR35 might be something that's come into place that they've said, actually, we can't have you as a contractor for us. you have some invoices due to you and they aren't paid on time. So again, global pandemic comes back to that they suddenly can't pay you within the usual 30 days. It moves out to 90 days. What is the impact? How are you going to go about that? So there are the support mechanisms at the moment, but it's just, if I change that number in my spreadsheet or in my Xero, what then happens to everything else? A key supplier can't provide you with goods, or again, the other way around is once you pay them quicker, how's that going to impact on you? They might call in all their credit terms. They might have furloughed all their staff and can't make the supplies to you. So yeah, just lots and lots of things around that you can play around with. Now, a lot of these things here are sort of scenario planning, and a bit of a plug for our third webinar. We've got a little bit more around scenario planning and also reverse scenario planning, where you start with the worst case scenario and work backwards and think, well, that's pretty bad. What things could lead to that? So thinking about it the other way, but we go into that in more detail in webinar 3. Other impacts, changes in price of materials. So suddenly, well, I say price of oil, but price of oil has gone the other way. Price of oil has fallen through the floor. So actually, yeah, if suddenly everything's oil is cheaper, how does that knock onto everything else? Is positive or negative? Exchange rate fluctuations. This is possibly more of a Brexit point than a COVID point at the moment, but if the pound is suddenly to get a lot weaker, does that impact you either positively or negatively if you're a supplier or an importer or exporter? How do these things impact on you? We've got some competition out there that's suddenly come in and undercut you. Oh, okay, sorry, I'm really sorry. What happens then? Do we need to then look at our pricing strategy? What does that mean? What can we do about this? If we are to cut 5% off our margins, where down the road does that leave us? Is there something we've got in development that we need to pump a load of money into quickly to get that new product out or that update out to keep us ahead of the market or the competition? And then finally, regulations may change. So for some of our clients, reverse charge VAT for construction is going to be a big one. The government do keep delaying this, but when a lot of our contractors or builder clients are going to have to start thinking about holding on to the VAT for their CIS subbies, that's going to have an impact on them, because short term they might have a bit more cash, but they're going to have a bigger VAT bill to pay. And they're probably not thinking of that. Well, almost certain that 90% of them aren't thinking that. So we need to make them aware that their cash is going to look better, but don't take all that money out because you're going to have a bigger VAT bill in a month's time. A few other things on cash flow to bear in mind. Have a think about things, if you've got loans that are guaranteed or have covenants on them, that the banks might want to see that you're, I don't know, you might have certain things that you've got covenants to keep. So you need to be able to track that, and just to make sure if they were to check, or you need to report to them that you're going to be in a good place to be able to do that. Okay, sorry, got a few positive ones now. So as we said, bounce back loans is possibly a little bit of an unexpected windfall. I say windfall is a loan is due back. Also the grants, the rates grants, if you were doing a cash flow a year ago, obviously you weren't expecting these. So where does that sit in? As John and Fiona said, they've received the bounce back loan, but what do we do with it? How can we use this? A few of our clients have taken the loan, not really knowing what to do with it, but it's a fairly cheap source of funding at the moment that with relatively good terms. So get it whilst we can, and then we start thinking, what can we do with it? How can we best use this money? Also, other things at the moment that aren't due. The VAT was delayed for a period. Also, corporation tax and POA. If you are struggling, you can speak to HMRC and ask about delayments. So that's things to bear into your your forecast, and then you can play around with and see what you can do. So cash flow template, not too much detail today on this because we've got pretty much a whole webinar, or not a whole webinar, a good half an hour slot on building a cash flow template. So I won't go into too much detail now. But they just look scary. They look horrible. I don't personally think that, because I do quite like Excel spreadsheets and playing around with all these numbers. But I appreciate that some people do see this and just think, oh my word, how do I go about doing that? And what am I working towards? How can I get there? So we're working towards working out what your cash balances are. At the moment, I've said at the end of every month, but you can put that into weekly, quarterly, annually. I would suggest annually, but you can then start breaking it down. And as the point of this is, you can manage when your cash flows are tight, and it allows you to plan, make decisions based on good numbers. So a bit of the construction, you're looking at money in, cash flows. So actually looking at actual cash coming into your business, not when you send the invoice, when that invoice is going to be paid. Now, for some businesses, cash card sales, point of sale sales, fairly easy to think about. But you then do need to think about, if you have a mixture of the two, you send an invoice, when will that be paid? Will it be by the end of the month, next month? In this month, we get, so for example, in January 20, would the December invoices be paid at that point? Possibly, possibly not. And start playing around with that, or factoring all that in.
Just a quick point in there, Will. If you use PayPal, PayPal often hold a retention against your account and only release that after a period of time, depending on how well your account has serviced over a period of time. So although you might get credit card sales and you think, oh, well, within 24 hours or 48 hours or whatever, that money would come into my bank account, that wouldn't necessarily be the case with PayPal. You have to factor in that retention period. So it's really important to think about those, look at those things and see when you actually get the cash coming through.
Thank you. I do think the money in part of the cash flow template is the hardest part of it. There's so much to think about and factor in, and it's out of your control. That's the hard part with the money in. So with the next bit, like I'm onto the expenses, you're going to a point, you know when your direct debits go out, you have an amount of control over when you make the payments of your invoices. Money in is, hopefully it's not a lottery, but it's harder to get it spot on, which is where over time, if you prepare these and then do look back at how it's worked in the past, how good is your forecasting and estimating. Also use other tools such as Xero to see. It tells you how long customers on average take you to pay you, that sort of thing. You can start building everything in and get a more and more accurate forecast. Sorry, just on the last one here. VAT is also something to consider. There's two ways to account for VAT in the cash flow. Include everything gross of VAT, which might be the easiest way to do it because that's physically the cash that goes out, or put everything in net, but at the end of money in and money out, have a line for VAT that you've paid in the month or VAT you've received in the month, which might be easier if you're exporting the numbers from some accounting software. If you export these numbers from Xero, it would tend to do it net, although I have found a function where you can include it gross of VAT, which is very pleased with. But you also then need to remember once a quarter or once a month, you do need to factor in your VAT payment or refund due to you as well. So moving on to the expenses, cost of sales, your direct costs. So materials in, potentially some wages in there. What else? Anything apart from overheads, which is my next one. All list of overheads. I've taken this list from Xero's standard profit and loss. So there's lots and lots of different things in here, but you tailor this for your business. And then you need to think about other cash movements. So things that don't hit your profit and loss account sometimes get forgotten. Money that you put into the business, money that you draw out. Said your VAT bill, your corporation tax bill. Another one that I thought of the other day was PAYE. So if we go back to your overheads in here, we've got wages, hopefully somewhere down the bottom. That figure should be the net wages. So the amount of money you pay out on payroll day, last Friday of the month, last day of the month, that should be the net figure. And then down here in other cash outflows will be the PAYE and NI that goes out on the 14th of the next month. So just, you have to start deconstructing some of your figures, see when those actual figures go out. Another thing to consider is if you're making any large fixed asset purchases, they won't go into the profit loss, they'll sit in your fixed assets. So you need to bring those in as an outflow. But back on the overheads, you wouldn't include depreciation on here because that's not a cash payment. That is an accounting adjustment that we like to make that then confuses everyone. Depreciation, say not a cash payment, so you wouldn't include it here. Another sort of thing to consider here would be insurance. Possibly you pay this as a one lump sum once a year. So you put in the day that is paid, not days that the accountants then play around with to say actually that covers a whole year. And as I said, we are working towards showing what your cash balances are at the end of each month or period. So you can see for this one, the final month, they've got quite a big cash deficit. So they need to start thinking at that point in time, what can we start doing to mitigate that? So it looks like there's a big 10k movement for some reason. That might be a VAT bill. So can we think about speaking to HMRC? Could we extend our overdraft quickly? Do we need to put some cash in? What needs to happen here? What can we do to help with this? I did see someone asked a question. I cannot find the chat box on my screen.
Let me read the question to you.
Thank you.
It's John and Fiona. We used Cashflow spreadsheets for SEDA grants, SEEDA grants, and in loan applications when exporting against LCs, letters of credit. Unfortunately, we've let it slip since we've been doing smaller UK projects and generally have a positive cash flow, proper down payments. So more of a statement than a question, really.
Good. Good to hear. So now a few little tips on getting cash flowing into your business. I said another plug for a future webinar. We've got much more detail on these, both how to get money in and how you can plan your payments out. Don't want to say stop paying because you shouldn't stop paying, but how you can manage your cash flow. So can you look at your debtors, your money coming in? Is there any improvements you can make to getting your money in? Another plug here for Xero, but you can make payment reminders in Xero and you can bring in integrations to make it easier for your clients to pay. What you want to do here is to make it easy as possible for them to pay you. Don't give them any excuses not to pay you. I said, plan your supplier payments out. So work out when the due day is. Will you have cash in the bank at that point to pay it? Can you speak to your suppliers and negotiate on terms should that be needed? And then access other support. So just moving on to Xero and automating emails. This is something at Revel we use. So when we send out an invoice, it goes out with an email from Xero saying, hello, this is your invoice. It is due within so many days or on this date. It's all set up to happen automatically based on the email address in the system, and it goes out. You can tailor these messages as much as you like. You can then set it up to send out emails when the invoice is becoming due, is overdue, say, and you can again tailor the wording. So you can start off by saying your invoice is due within 7 days. Please, can you make the payment? Any questions? Then it's due today. Please pay us. It's due 7 days after. The emails get stroppier and stroppier until it is, if you don't pay us, we're going to withhold services. You can tailor all that. Also, once the invoice is marked as paid in Xero, these stop. So you don't need to then go in and cancel the reminders. It does it all automatically for you. Making it easier to pay. So typically on an invoice, when you send it out, you say, these are our bank details, please can you pay? With Xero, and I think QuickBooks would do it as well, you can actually have a live link on your invoice that links to PayPal, Stripe, Go Cardless, so that customers can pay you by clicking on the invoice. And it's great. It's making it one step easier for them. The argument is that all these things are going to charge you a fee to do. Sort of PayPal certainly will. However, if they're going to pay you within the next 10 days quicker when they receive the invoice, is that £1, however much fee, worth it? I would argue quite strongly that it is. So it's something you can build into your systems or into your invoicing. Say it goes out as part of the email to the client and they can click on the invoice. So say PayPal works as PayPal does when you're buying anything else. They can just pay instantly by clicking that. Go Cardless is a function where you set up a direct debit or standing order with them, with a client. So you can tell them how much you'd like them to pay and they can set that up. And I know Alan uses that for the hub. He's got that integrated. And then we've also got Stripe, which is similar to PayPal, but it's more of a card merchant ability to pay your invoices. Alan, are you there?
I am.
I know you quite like PayPal for deposits.
Yeah, I used to take PayPal. I used to use PayPal for deposits on our motorhomes. I would much prefer people to pay me the deposit using PayPal because it made life so much easier for me. Because assuming that I actually didn't do any damage, as soon as I checked it over and made sure that there weren't, leave it at a 7-day period at least. To make sure that we didn't get any reports coming back through the police or insurance companies that they'd clipped somebody else or done other damage elsewhere. But running the vehicle was fine. I could just simply go into the original payment and refund it instantly. So it reversed the transaction automatically. I didn't have to get their bank details to send the money back. And the wonderful thing about PayPal was when they do that, they actually reimburse you the fees that they charged when they took the original payment. Whereas if you use Stripe or any other payment provider, they actually charge you for taking the payment. And then if you refund on the credit card, they charge you a refund charge. So just for holding that deposit would cost me a certain percentage of the deposit full stop. So it would eat into my profits. Whereas PayPal, there'd only be a charge if I had to retain any of the deposit to cover some damage. Yeah. And I would always have an admin charge for handling any damage anyway, which was used to cover the PayPal charge. So it was a much better way of processing deposits.
Yeah. The other thing with all these integrations are a lot of them add into Xero as bank accounts. Now, if you've used Xero before, you'll know that the great thing about it is that it automatically brings in your bank account transactions and you can tell Xero what to do. So you can set PayPal to become a bank account. So if someone pays an invoice, it matches against the PayPal receipt in, rather than when PayPal deposits into your bank account, which a lot of the time can be different. As Alan said, they sometimes hold money for you, or you might deposit 3 at once into your PayPal account, and it will also work out all the fees for you. It does a similar thing with Stripe. And Go Cardless, I believe, has a full integration into the whole invoicing system. So any of these things, do get in touch with us. We're more than happy to talk through them and help set them up should they be required. Just one other thing, you can also set up different payment methods to go on different types of invoices. So in Xero, you can have different branding themes. So if someone already pays you by standing order, you can set it so this wouldn't show up. Or if you want to promote this to certain clients, you can have certain themes so it targets them. Just on the other side of things about you making payments out, plan when these are going to become due. Don't sort of head in the sand. Do plan when things are going to be due. Can you speak to your suppliers and talk about changing your credit period or set up payment plans with them? If you've got a big invoice that you know you're going to struggle to pay, I would always urge get a conversation going, have a word with them and see if you can pay over installments. People are always much happier to talk to you in person than you not telling them a thing in the last minute, send them an email saying, sorry. Much happier, and it will probably make the relationship stronger if you do start talking to them. And finally, other support that's out there. So the government bounce-back loans are open till the 4th of November. However, I have heard a couple of the banks are stopping applications, or have got so many applications that they're struggling. I do know that HSBC will take applications from people that don't bank with them, and generally being pretty good. But yeah, for instance, Starling Bank, I know, are being a bit slow with everything at the moment. The other grants and loans, I think, the other grants, the rates grants and the council discretionary grants, I think they're all pretty much closed now. So that ship has sailed, I'm afraid. Yeah. And finally, HMRC at the moment are being very accommodating on delaying tax payments. The VAT automatic deferment has now stopped. So if you were a May that quarter end, your VAT is due, or your VAT return is due tomorrow, and the payment by the 14th is due on the 14th of July. The cut-off date was the 30th of June, which wiped you out of that scheme. But if you are having any problems with any taxes for HMRC, do give them a call on the number on the screen. Just to mention, the self-assessment July payment on account is also automatically deferred, so you don't need to make that now. You still can do, but if you're not going to, you also do not need to tell them. Please don't ring them up to tell them you're not paying them. They will not want to hear from you in the nicest possible way. Any questions? Doesn't necessarily have to be about cash flow. Happy to talk about beer or Gloucester rugby or anything else to do with accounting. And just the final few points here on, sorry, we're doing updates. Laura has been very busy on providing updates to clients. So we've got a whole web page of all of our updates. And if you would like to join any of our next 2 webinars, Alan posted the links, but if you do Google Eventbrite Revel, you'll find this link, which you can see the next 2 that are coming up. And subscribe to us. We are planning to do some future webinars as well. Cashflow is just the beginning. Thank you all very much.
Yeah, thank you.
I don't seem to have any further questions there, Bill.
Can I have a cup of tea?
You definitely deserve one. Well done, Will. Thank you. Thank you
Well
for
done,
hosting us as well, Alan.
That's a pleasure, Laura. That's a pleasure.
Thank you.
I will try and join you tomorrow. I need to register for that, I must admit. Won't be able to join you on Wednesday, unfortunately, because I'm due to go to Loughborough to help my son get out of his first year accommodation and into his house that he's moving into for next year. So yeah, that's going to be a fun day. Yeah. Right. Thanks, everybody. As I say, we'll be back on Monday at the Hub with either my practical funnel example, if I've managed to make enough progress during the week, or we'll do Mastermind and delay the funnel to the following week. And for those of you that are involved, we have the Link Business Mastermind Ask Me Elnet's topic call this week. So I've had one suggestion for a topic. If anyone else has got a topic that they would like me to cover at the Mastermind call on Friday at 12 noon, I will pick it up to put it into the LinkedIn group or message me. Thanks, everybody, and see you all again soon.
Thank you. Thank you.
Bye.